Hello, Paul Gerard from Price Accounting Services, back talking to you today about trusts and in our series on structures. And in this episode, we're going to discuss unit trusts. Okay, what's a unit trust? A unit trust is a trust that gives the unit holders a proportionate beneficial right to the assets and the income of the trust property. So if we use the analogy of a company that has shares, and we know that shares can be issued to various shareholders, so you can turn around and say, right, Dad owns 10%, Mum owns 20%, and the family trust owns 70%, for example. And that gives a 10, a 20, and a 70% right to the income from the company, etc. A unit holder is not greatly different in that units confer rights, and it, depending on what the deed says, depends on what those rights are. But let's assume for the moment that we're talking about what in accounting terms we call a fixed trust. So a fixed trust has one class of units, and those unit holders each have the same rights for each unit. Okay, so for example, Dad has 50 units, Mum has 50 units, so it's 50-50 unit holding. And so any profit that's made, Mum gets 50%, Dad gets 50%. Dad can't refuse to give Mum her 50%. And so if we start thinking in terms of a unit trust where it can be beneficial, it's a good way sometimes to replicate a partnership, because you can have unrelated parties who each have a fixed right to income and assets of the trust. So it's good for property ownership, and it's good for some business structures where you don't want to get into a partnership where there might be joint and several liability. Perhaps a unit trust, if it's correctly structured, may be an alternative. And this is a question to put to your lawyer and your accountant prior to establishing any form of trust, of course. What else does a unit trust have as a feature? Well, unlike some forms of trust, the unit holding will commonly be one class of units. So you can't generally with a unit trust turn around and have, for example, a right to capital gains but not ordinary income. That might be a feature of a different form of trust we'll discuss later, such as a hybrid trust. We'll talk about that further into our series. Another feature of a trust will be the fact that it has what's called a trustee. And the trustee is the legal entity that will own the property with its property or own the business. So commonly when we have a fixed trust or a trust, we will have a company or individuals as the trustee. And the trustee is the one that manages the trust. It's the one which will sue or be sued in consequence with owning the property or running the business. So you'll have ABC Proprietary Limited as trustee for the whatever the name of the trust is. And it might be, for example, the Gerard Unit Trust, or it might be the Pitt Street Property Trust, whatever name you choose. The trust deed will be drawn up by a solicitor, and the initial unit holders will settle the trust entitlement by subscribing to those units. So they have to apply for their units at the time of formation of the trust, and the trustee will issue units to them. And the trustee from there forward will maintain a register of unit holding. And that register of unit holding may change. For example, commonly we see people who buy property, later then put more money in for a deposit, borrow more money, and so there might be a change of unit holders. More units might be issued. So the register of unit holders must be maintained because it shows who owns the units and what proportion they use. And as accountants, we can assist with that process of maintaining that, and we can assist with generation of some documents at times, and other times you might need to do it yourself, alternatively see a lawyer regarding the constitution of the trust deed. But each needs advice, so it's important to do that. So I hope that explains a little bit about unit trusts and their structure, and we look forward to seeing you in another one of this series where we talk about some other forms of structure. Cheers.